for people to join in, and then we'll start. Welcome to the launch of the Pension Funds, Private Equity and Private Debt Study in Southern Africa. FSD, in partnership with SAVCA, commissioned the study, and the research was undertaken by Intellidex, and I was the lead researcher on the study with the support of my colleagues. The research will be used to support policy and regulatory development in the region with the aim of increasing the uptake of private equity and private debt investments by pension funds. A similar study was undertaken back in 2018 with FSD Africa partnering with East Africa Venture Capital Association and the IFC. And the focus then was on East Africa, and they covered Ethiopia, Kenya, Tanzania, Rwanda, and Uganda. However, today the focus is on Southern Africa. My name is Shalati Baloi. I'm the Development Finance Research Manager at Intellidex, and I'll be your host this afternoon. And I look forward to a very interactive and insightful session. Apologies about my camera. We're experiencing load shedding, so my bandwidth is quite low, but trust me, I do exist. Starting off with the agenda for today, I will introduce Brian Yala from FSD Africa and Shelley from SAVCA. I will then do the presentations of our research findings and recommendations. I will then proceed to invite our esteemed guests for a panel discussion. I will open up the floor for a Q&A session, and then I will invite back Brian and Shelley to do the closing. Allow me to introduce Brian Yala from FSD. Brian is an investment and capital markets professional. At FSD, he manages the implementation of capital market development initiatives and programs in close collaboration with strategic partners, including governments, policymakers, and regulators, among other stakeholders. Brian, the floor is yours. Thank you.
Thank you, Ntalati, for that introduction. So let me quickly just move into briefly introduce FSD Africa for those who may not be very familiar with us, and then I also give some context on the study from our perspective and just shed more light on our involvement. So FSD Africa, we are a specialist development agency, and we work to build and strengthen financial markets in Africa. Our aim is to try and reduce poverty through what we call a market systems development approach. And by market systems, we basically mean we are trying to address the structural and underlying issues and challenges so that we can be able to improve how financial market systems function. And we do this by basically partnering with governments, business leaders, regulators, policymakers, among others, in developing and implementing ambitious financial sector development programs. We work across various sectors. We work across various themes. We work across various areas. And we have 4 main teams. We have a capital markets team. We have a team working on risk and resilience. We have a digital economy team. And we also have an investment arm called FSD Africa Investments. We have a strong focus on green finance across all the areas that we work in. And I think the ultimate objective is obviously ensuring the system is efficient and we're able to make finance work for Africa's future. Narrowing down to the capital markets team, we are currently implementing about 50 projects in 33 countries. Obviously, this is one of the projects. And those projects include other initiatives in the Southern Africa region. Narrowing it down to this study and where it's situated in terms of our programming. So in February of 2021, we launched a program we call the Africa Private Equity and Private Debt Program, a very ambitious program to try and support development of private capital markets as a complement to public capital markets. And the goal of the program is the overarching goal, that is to support mobilization of long-term finance in local currency to be able to fund Africa's development and economic priorities. When we talk of local currency, just to give an example, pension funds, which are the largest institutional investors in the continent, they hold about 500 billion US dollars worth of assets. But their allocation is significantly biased towards traditional assets. You'd find less than 1% allocation in alternatives or private equity and debt in most cases. And so this is what we're trying to correct, if I could use that word, because we believe that allocating more capital to private markets is actually beneficial in the sense that pension funds are able to, one, improve their risk-adjusted returns, as well as contribute to economic transformation of the continent. So through the program, we are looking at developing private capital markets in three ways. One is trying to partner with regulators to create a facilitative environment, regulatory provisions or incentives that will allow institutional or will make it easier for institutional investors to invest in the market. Second, we want to see if we can support demonstration transactions. Of course, these would be vehicles that now will make it again easier for institutional investors to actually come into the market. And thirdly, we are trying to support capacity development initiatives. We are trying to do research, advocacy kind of work, impact reporting, so that we're able to move the needle in terms of driving investment. And then just to mention that we have partnered with various partners under the program. Of course, SAVCA is one of them. We've also partnered with their other sister associations, AVCA, EAVCA, PEVCA, more recently GVCA, a new kid in the block, so to speak. We've also partnered with regulatory agencies on specific regulatory initiatives. And like I mentioned, one of the things we're trying to do is trying to actively originate and identify potential transactions that we can support. So as you may have already sort of noted, this piece of work falls under the third programming area of research, capacity building, etc. So I hope that provides a good background. We look forward to fruitful engagement and deliberations in this session, and potentially follow-on engagements in the context of this particular program. Thank you very much. Back to you, Talati.
Thank you so much, Brian. Now I introduce Shirley Lotz. Shirley is the head of regulatory affairs. Her focus is on leading SAVCA's engagement and advocacy efforts with regulators, including the National Treasury, SARS, the South African Reserve Bank, and the Financial Sector Conduct Authority. Thank you so much, Shirley. The floor is yours.
Thanks, Shalati, and good afternoon, everybody. It's great to be here. SAVCA was really excited actually to partner with FSD Africa on this research project, as we really do believe that the pension and the retirement funding on the continent is really the key to unlocking the development for Africa and in the region, as well as to catalyze growth. So what we've seen from various engagements with international investors and local investors is that really the international investors, they understand private equity and how the markets operate and how the structures work. But they are still uncomfortable with the political risk and what does it mean to invest in a different continent and in emerging markets. What we've seen from local investors is they tend to be a little bit more unsure of the actual asset class. And we believe that both are needed to be able to catalyze this growth into this development asset class. As the Southern African Venture Capital and Private Equity Association, our strategic objectives are promoting the asset class, being private equity, and then doing policy and regulatory advocacy, which is primarily my role, as well as capacity building and providing network opportunities for our members, and then supporting the transformation of the industry. And that's pretty much all from me, and I look forward to what we hear from Shalati and then discussing it further later. Thanks very much. Shalati,
thank you so much. Thank you so much, Shirley. Okay, I will now present our research findings, and bear in mind that the research is quite detailed, and I will not touch on everything. So I'll try and present almost 4 months work in 30 minutes. Okay, so I'll start off with the research summary. The purpose of the research was to understand and examine the different approaches to private equity and private debt investments in private debt investments by pension funds in Southern Africa. The objectives were to understand and review the status quo, understand opportunities and the challenges, and most importantly, to make recommendations for policy and regulatory changes. And then just to give you a high level of the methodology, we carried out desktop research. We also sent out over 120 surveys. We sent out over 120 surveys in 8 countries, and we got 52 responses. And of the 52 responses, 49 were from registered pension funds and 3 were from regulatory authorities. And of the 52 completed surveys, 4 were completed by our own analysts using the fund's annual statements. And the countries that we studied include Botswana, Eswatini, Lesotho, Mozambique, Namibia, South Africa, Zambia, and Zimbabwe. And what we found is that the funds that responded they represent 160 billion in assets under management. That translates to 30% of the coverage. And very interestingly is that we found that it was a diverse set of markets in the region with unique challenges. I'll just give you now a regional snapshot of the different countries. Starting with South Africa. South Africa has it was the most dominant, the government employees pension fund was the most dominant out of all the respondents. And the country is, the industry is regulated by SAVCA, and we saw recently the Regulation 28 amendments, which will be effective on the 3rd of January 2023, which increases the allocation to private equity from 10% to 15%, and this is a welcome amendment. And then moving on to Botswana. Botswana has, the market is very developed, but what is this now? The maximum exposure to private equity is 5%, which is divided 2.5 in private equity and then 2.5 into private debt. And then looking at Namibia, Namibia is quite interesting in the sense that Namibia is the only country where we saw it has a minimum asset class exposure as well as a ceiling, with a minimum of 1.75 permitted allocation to private equity and a maximum of 3.5% to private equity. Moving on to Zambia. So Zambia is divided between public funds and private funds. And then with the public funds, the permitted allocation to private equity is 10%, with the private is 15%. And this, last year, there was also a revision from 5% to 15%. This was very welcomed. And there are two regulatory authorities, NAPSA regulating the public funds, and then PIA regulating the private pension funds. And then now moving to Zimbabwe. Zimbabwe is interesting in the sense that there's a lot of registered funds, but very few active funds. And they also have what they call prescribed assets. So, and the minimum, there's a minimum of 20% for the prescribed assets. But what we found is that a number of industries were non-compliant. And then they recently also proposed a 15% increase in the private equity allocation to private equity. So, and then moving on to Lesotho. So just to give you just an understanding of how I'm approaching this, I started off with South Africa, which is more mature and advanced economy, then moving on to more developed markets, and then now moving to an emerging markets, and then I'll finish off with the nascent markets. Lesotho, we considered Lesotho a very emerging market. They are regulated by the central bank, and the permitted allocation to private equity is 10%, and private debt is between 1% and 5%. And then now moving on to Lesotho. So Lesotho, they do permit allocation to private debt, but private equity and private debt, but the threshold is not clear. And we also found that pension funds currently do not invest in private equity. And then most funds mostly invest in government debt. And then lastly, Mozambique. Mozambique, same story with Eswatini. They do allow private equity and private debt allocation. However, the threshold is not clear. And we also found that there is no direct allocation to private equity by pension funds. However, there were some investments in unlisted company shares, but they were through, many of these were property companies. Now I'll just move on to the market hindrances, starting again with South Africa, which is more a mature and advanced market. So what we found in South Africa is that the deteriorating economic environment was the biggest hindrance to allocation into the asset class. There's also a lot of policy uncertainty, and we've also seen with civil unrest, and now there's load shedding. There's just a myriad of challenges that are currently facing the economy. And we also saw that the defined contribution nature of funds makes it so difficult for pension funds to invest to allocate in private equity. And this leads fund managers to avoid these illiquid assets. Because remember, the fund managers have to be able to maintain individual assets, and they are required to have a payout if a member leaves the fund. Botswana, on the other hand, they have a very restrictive maximum exposure limit for the private equity and private debt. And the industry has suffered reputational issues that were stemming from litigation over past private equity investments. Moving to Namibia. Namibia, regulation 13 is very prescriptive in terms of the exposure of investments in unlisted investments. And we also found that there's a lack of feasible asset classes. Zambia, Zambia, what we found was that there's limited appetite for the asset class. What was also interesting is that we found NEPSA, which was one of the biggest private funds, doesn't allocate investments in private equity. And there are there's also government influence where pension funds have to invest in certain projects that the government considers strategic, which includes tourism, real estate, and cement projects, but not necessarily via private equity instruments. Moving to Zimbabwe. Zimbabwe is plagued with political instability, lack of confidence in the government, and the biggest issue that we saw was hyperinflation. And so because most pension funds were invested in fixed income bearing instruments, so the value of the assets were eroded during hyperinflationary periods. So as much as this was an issue, it also presented a challenge because a lot of pension funds started pursuing alternative assets, particularly private equity and private debt, as a method of hedging their investments against inflation. And we also found that there are binding constraints from the supply side. Lesotho was interesting in the sense that there's currently no regulatory framework for private equity assets, as much as the Pension Fund Act was amalgamated back in 2019, but it's very restrictive in allowing for exposure in private equity. We also found that there's also political instability and lack of confidence in the government. Eswatini, we saw that there was heavy exposure to in-country debt, so resulting in inefficient asset allocation for pension funds. There's political instability and lack of confidence in government. And then lastly, Mozambique. Mozambique is quite unique when looking at all the other markets, in the sense that the industry is dominated by the banks. So banks, they mostly make direct investments into, they make investments towards deposit accounts or bonds instead of alternative asset classes. We also found that Mozambique is also plagued with reputational issues following a bond default. And what was also interesting with Mozambique is that there are linguistic and cultural differences, and the country still replicates the Portuguese system and does not follow international best practice on patient capital. And there's also a lack of transparency of the financial sector. Okay, I now move on to the questionnaires that we sent out, and I'll not touch on everything, but just a few of the interesting questions that we asked, and also the structure and the makeup of the people that we had interviewed and also surveyed. So what we found is that we asked, so the survey was targeted, we were targeting principal officers and trustees because they were the desired respondent types, and the two groups make up 56%. However, in the end, the largest group of respondents was more varied, and this included that, so this varied group was made 36% of the results, and this included chairpersons, finance director, investment manager, compliance officer, chief accountants, and head of finance and investments. And with regards to the fund structure, we got an overwhelming number of responses from defined contribution funds. Then we asked, how important are the following investment objectives for your organization over the next 12 months? So what we found is that pension funds have a clear investment objective for their pension funds. So funds want high risk adjusted returns. However, at the same time, they want to diversify their portfolios, and most importantly, they want to do this in a very sustainable way. And all you can see with all these three, the responses were quite high, but this is not surprising. And especially now, given that the global economy has made commitments to their respective nationally determined contributions to decarbonize and invest in more sustainable investments. So it's more sustainable assets. So this was quite interesting to see, given where the economy is and the global economy is and where we're going with transitioning into cleaner and cleaner energy and having investing in assets that have impact. Then we asked, how does your fund obtain expertise for portfolio construction? And we found that over 80% of our respondents, they make use of asset consultants and third-party advisors, while a small number of respondents make use of in-house portfolio management. This was also not surprising because over 86% of our respondents were small pension funds. So these funds find it difficult to access a diverse range of investment instruments on their own, and that's why they make use of asset consultants where to invest in a range of asset classes. Then we asked, does your investment policy allow for allocation to private equity and private debt? And this was quite interesting that majority of the respondents do allow for allocation, investment allocation into private equity and private debt. But the challenges were quite different for different countries. So as much as from aggregate perspective, a lot of funds do allow for allocation into private equity and private investment. But when we disaggregate the figures, that's when we understand the challenges coming into play, given what I presented earlier on with the different countries. Okay, so now this is just a snapshot of the portfolio allocation to, this is disaggregated by countries. And while a majority of countries indicated that their investment policy allows them to invest in private equity and private debt, we can still see that listed equity and bonds is still the most popular asset class for pension funds in the region. However, we see countries such as South Africa and Zambia that have that are progressing and diversifying the portfolios by investing in alternative assets such as private equity and infrastructure. Okay, now I'll just move on to the regional findings. So we found that there's a nationalist mindset, and this prevents economies of scale. And with the nationalist mindset, we mean that all markets have a sharp distinction between their domestic and foreign asset allocation for the funds, but none provides a regional allocation. We saw recently with South Africa removing the allocation to the African exposure tranche. We also found that there's no clear taxonomy. And because of this, you find that information is often buried under different headings. We also saw in markets such as Botswana and Lesotho, where the markets are illiquid, there is no sharp distinction between the listed stocks and the private equity. So the listed stocks behave like a private equity portfolio in terms of the liquidity constraints. So this suggests that the private and listed distinction of equity and debt is in practice not clear, even if it exists in regulatory approaches. So we found that allocation to private equity and private debt, most funds do allocate to private equity and private debt, but allocations to private equity is between 1% and 5%, and allocations to private debt is more than 10%. And the hindrances that we found for allocating to private equity and private debt was the availability, or rather the lack of availability of investment opportunities, limited familiarity with the asset class and also the experience, and a very difficult regulatory environment, especially in countries outside of South Africa. Then we asked factors that would influence allocations, and the majority of the respondents indicated that value proposition, proposed fund strategy, and impact and ESG would influence their allocations to private equity and private debt. And again, this is no surprise with a post-COVID recovery emphasizing a push for sustainable investments that have impact. And then lastly, a majority of our respondents indicated that sustainable investing will become very, very important in the next 5 years. And the United Nations Principle for Responsible Investing influenced most of our funds investment approach into private equity and private debt. However, in South Africa, it was the Code for Responsible Investing by Institutional Investors. And lastly, what we found was that the South African pension industry is at the forefront of global best practice in terms of sustainable investment. However, the concept is still nascent in the rest of Africa. This is due to lack of information. I'll now move to regional recommendations. So we recommend that globally, we recommend there to be an increase in the maximum exposure limit to be in line with global trends, because we see what we found globally was that most large pension funds allocate on average between 9 and 10.3% of the assets to private equity, while smaller funds allocate on average 3.6%. We also recommend there be unbundling of the private equity from hedge funds, real estate, infrastructure, and other alternative investments. This will also, by unbundling private equity from the alternatives, will remove the taxonomy confusion that currently exists. And we saw in South Africa with Regulation 28 amendments that split the asset class, hedge funds, private equity, and any other assets into standalone asset classes. We also recommend that we also recommend there be a support for private equity skills and capacity development, both on a buy and sell side. And we also recommend that private equity be marketed as an ideal channel for domestic investment exposure. And we also recommend that domestic institutional investors invest in the region. So having allocation to the domestic, to Africa tranche. So have their domestic Africa and then offshore tranche. And lastly, we also recommend that there be specialist mandates that encourage asset consultants and managers to invest in the private equity asset class. And there's a pressing need to equip asset consultants and advisors, because we found that these are crucial and they're underdeveloped components of the ecosystem. Okay, so that was regional recommendations. I'll just move on to the country-specific recommendations. Looking at South Africa, we recommend supporting asset allocation in factoring private equity exposure into the portfolio modeling and advice. And we also recommend the introduction of lower liquidity fund vehicles, such as the EU long-term investments and the UK's patient capital regime. This will help deal with the illiquidity problem that I mentioned earlier on with the defined contribution funds that we see in South Africa. In Botswana, we recommend applying risk mitigating mechanisms such as due diligence, phased drawdowns, and project funds, and also having active monitoring and management of projects, and most importantly, market the private equity as an appropriate channel for domestic investment exposure. In Namibia, we recommend increasing the maximum exposure of permitted private equity as a class allocation tranches, and the modernization of the regulatory framework by disaggregating private equity from alternative asset classes. And in Zambia, we saw that the private equity allocation tranche was increased, but the increased limit exposure needs to be met by market opportunity. And I think here that's where there's an opportunity to work with the regulators to also offer technical assistance that will boost the success of the investment transactions in both private equity and private debt. And also from our interviews, we gathered that the country has quality pipeline in green economy, especially in hydroelectric, solar energy projects, and the circular economy. In Zimbabwe, we recommend developing private equity and private debt models that are resilient against inflation, and also supporting private equity skills and capacity building on both the buy and the sell side. In Lesotho, we recommend the development of a regulatory framework for private equity, and also, very importantly, supporting private equity and private debt firms that are trying to set up operations in Lesotho. And then Eswatini, given that the pension system in Eswatini is influenced by South African firms who provide most of the fund management and advice, so it is important to engage with the firms that determine greater allocation to private equity. And then Mozambique, we recommend there be an alignment of patient capital law in country, this in line with international best practice, and there be an engagement with banks to accept the importance of private equity in the market and be actively involved in improving flows to asset classes. We also recommend the development of a regulatory framework for the private market to overcome the reputational problems that were caused by the default of the bond, and also there be a support for incubation hubs such as the Mozambican Association of Business Angels that are trying to mobilize capital and fund venture capital businesses. Okay, I think those are all the recommendations from a regional perspective and also from a country level perspective. I will now invite our guests to have a panel discussion. Is the panel ready?
Oh, sure, we are.
Okay, awesome, great, thank you. I'll start with Aldo from Mozambique. So Aldo, in Mozambique, we know that the pension investment decision-making and management process is dominated by banks, so which is an obstacle to greater asset allocation to private equity. So my question is, have you seen a transition over time? If so, what is the role of banks versus asset managers in developing and furthering pension fund investments in Mozambique?
Hi, Salati. Yes, unfortunately not. We haven't seen such a change. We know that the regulating authority has launched a tender last year, they must stop for the change of the law itself. The hope there is that on this new law aligned with the central bank, it actually allows the existence of asset managers per se that can provide consultancy work for the pension funds. So far, the sole player, we'll put like this, the sole advisor for the pension funds are the banks. Some of the pension funds directly, as the law allows them, they can directly go do investments and add the assessment. but because of shortage of skills and other issues, has not knowing or not seeing other investment opportunities, they mainly work with the banks. If not through the banks, they mainly invest in government bonds with that in mind, or that the bias that government bonds are the only risk-free and good stable return investment that you have in the markets. Although they're quite right, sometimes there are few investment opportunities. But I would say that the point is that if you do not have asset managers and other skillful consultants, but mainly if you don't have asset management, there's not enough room or space for projects to be brought forward, the opportunity investments to be brought forward, duly analyzed and put onto directly to the pension funds.
Because you keep mentioning that there's lack of asset managers, but I understand that you were the first, you established the first Mozambican pension funds management company. How was that, and how were you able to succeed in establishing that?
Yes, I was part of the first pension funds management company that wasn't part of a bank or insurance company. When the law was enacted in Mozambique, it allowed private entities like the one we established in Mozambique Previdente, and allowed banks and pension funds and insurance companies that hold a life license to actually manage pension funds. We established this first company with partners. The idea was actually to leverage this opportunity. We succeeded. The company still exists. I left on 2 years ago, and I'm pursuing now as a consultant. I still consult to the funds directly. The idea here and what was how we managed to succeed, it was that we've worked on the full chain of value. So we actually worked with the companies to create the pension funds. We did the engagement with management, with employees. We would register the fund itself on the regulator, and then move on to do part of the asset management. So we weren't just managing the pension funds differently than South Africa. Our law allows actually that the asset manager, they put us in the same place as the asset manager and as the pension fund administrator. So we will just basically a one-stop shop. It's not ideal in terms of guidelines, in terms of governance, but it was what we still have in the market. And we managed to succeed because we were putting on a new challenge to the market and a new face to the banks. Because the idea, since we had the mandate to actually invest directly and then make a few decisions, we were trying most to diverge from the banks. Of course, you have the liquidity issues or questions, and that you have to have the money to pay on the pension and everything. But we managed to actually start the idea or the notion that we could invest outside the basic bread and butter that the banks were offering.
Okay, thank you, Aldo. I'll come back to you. Mr. Elia, we can move to Zambia. Can you paint a picture of the current regulatory challenges in Zambia that hinder pension fund investments in alternative investments? Thank you.
Thank you, and good afternoon once again. I think that's a very good question, because we've seen quite a lot happening in the market regarding alternative investments. And what I may point out is that we've seen some firms which have been coming up and requesting for some kind of blessings from the Pensions and Insurance Authority in Zambia with regard to going out to the pension schemes that we regulate. Obviously, that's unfortunate because proper investments may not work that way. So I'll just draw just a few lessons from the recent firms that we've seen, which came on board. Some of the entities that came on board were just too new in the industry as well as in the market. So, you know, for me, what I believe is that in the pension world, every coin matters. And if you have to put pension funds to a test on virgin firms, that becomes very risky. I know that serious entrepreneurs will have already demonstrated their business acumen by not only the deeds, but works as well. So they just have to start from somewhere for pension funds to entrust in them. And another matter we noticed in Zambia is entities being unfamiliar to the governing regulations. Unfortunately, the old firms that were coming up as well as the new ones did not bother familiarizing themselves to the governing regulations. For example, we introduced the new SI number 50 of 2021. These are simply investment guidelines, and they provide very good prudential guidelines with regards to investments. And these entities were unable to follow the basic guidelines. And also the other issue is that there was lack of financial history to these entities, how they've been performing over time. Some firms did not even have audited financial statements, and that made assessment of these firms very difficult for the pension schemes. And in the event that they had management reports, these management reports were not really, consistent. Then the other lesson that we saw from this is that most of the alternative investments which were coming on board were quite illiquid. And you would imagine, I remember one entity had a proposal on the table where they wanted to build blocks of flats. And this is in an isolated place. So we're just wondering, because, we are in the advent of COVID-19 pandemic, and most offices have been left, vacant. And there is someone who wants to use pension money to build blocks of flats, So this illiquid, there's some illiquid nature with regards to such alternative investments. Yeah. Then the other issue that we saw is with regards to valuations of the same investments which were being advanced. The valuations were quite questionable because their prices per share were so exaggerated. And if you are to go into them, you will just find that there are serious issues which were attaching to their valuations. Then we also saw that there was lack of independent research on these entities. So it was difficult to really find out about these entities, how they've been operating, including their governance structures, very difficult. And you find that the pension funds were having serious challenges. Yeah, so those are some of the issues that we saw from the recent applications which were coming through in trying to see how they could tap into the Zambian pension funds. Yeah.
Okay, thank you. So you mentioned CI50, which is the investment guidelines, right? And the investment guidelines, they basically, there was a revision of the private equity asset class threshold from 5% to 15%. However, the pensions allocations in Zambia are still quite low. And we also saw from the respondents in our survey that a majority of respondents currently allocate between 1% and 5% to the asset class. So what regulatory interventions or reforms will see increased allocations by pension funds to private equity and private debt in Zambia?
Yeah, thank you so much. You're actually very right. I think the statutory instrument number 50 of 2021 has increased the limits of alternative investment to 15% from 5%. And what we've seen over time is that the investments have really been quite low, and that has been worrying us because you can imagine if even after providing the 5%, the pension schemes could not satisfy the all 5%. And now we have even increased it to 15%, which is quite a good thing. And we are hoping that the pension schemes can now go in out and just ensure that they work with the firms that are providing alternative investments. And the other thing that I can say is that over time, for the past 5 years, the industry has not satisfied the allocation of 5%. And it is very sad, because we know that diversification is very important, and alternative investments are providing the much needed, income and growth, as well as security, if you are just able to harness these things properly. So as the authority, what we are trying to do now is to provide an enabling environment in the alternative investment space. So we usually have trustees workshops that we hold every year. I think on a quarterly basis, we have at least one trustees workshop. And in those trustees workshops, we are trying to provide the basic education to the trustees, because ultimately they are the ones who provide the decisions in terms of investments, even after the fund manager or investment manager has advanced their case. So we are trying to provide that basic knowledge so that they are able to, to undertake the alternative investment space. Apart from that, we are also considering having more discussions with the investment managers themselves, so that they can look into this space. Because as we can see, these alternative investment, they provide the much needed income, especially in times of turbulence. The provision that we've done, increasing the limits, is good, and it has been welcomed. I remember at one time when we had a minimum limit on some alternative investments during the global economic crisis, the industry cried foul and said that it is because you are the minimum limit, so you are trying to force us to invest in such vehicles. So we removed most of the minimum limits. I noted that, is it Namibia, which actually had, it has minimum and maximum limits. I don't know if they had a similar encounter, especially during the global economic crisis, because especially alternative investment, they fared quite badly compared to the traditional investments. Yeah. So in a nutshell, we want to see the pension funds undertaking the alternative investment platform, and the limits that has been provided are good enough. And we just want to ensure that, I think, for us to reach the economic development that we need, these pension funds, as well as people or investees providing alternative investment vehicles, they should be able to talk to each other and iron out all those thorny issues. I think in that way, we'll be able to prosper. Thank you.
Thank you so much, Mr. Elia. We now move to South Africa. Mr. Langa, what is the recent level of pension fund activity in the private equity market in South Africa? Can you just paint a picture for us?
Thank you very much. I think in the South African context, the pension fund investment into private equity is definitely on the up. I think we saw a significant number of pension funds making investments into private equity for the first time in the prior period. I think the dampened mood within the listed markets during the COVID pandemic, and most recently now with all that's going on with Ukraine and inflation globally dampening the markets even further, they are looking for new drivers of achieving alpha and that superior risk-adjusted return of which you spoke. And private equity is proving to be one of the areas where there's resilience. And so they are looking to invest there, and there's an increased impetus to direct resources into unlisted investments. I think also South Africa is in need of economic stimulus, and also in need of meeting some social objectives. And private equity is proving to be one of the conduits for being able to do that. And as pension funds start to align with SDG goals, with UNPRI, there's an increase in terms of the levels of investment that are going into private equity in the South African context.
Okay, thank you. And then a follow-up question would be, what was the market reaction to the 2021 proposed amendments from a retirement fund perspective?
So there were several proposed amendments, but I think you would be referring to Regulation 28. And I think
Correct, yes.
I think many of the players that are in the market from the pension fund space saw it as positive. I think there is a general sense that it's important for us as South Africa and Africa in general to start mobilizing our own capital to invest in the upliftment of our own economies, that we need to be channeling resources into making sure that we've got positive, sustainable growth within various sectors, and we're creating the jobs so that we actually benefit from the demographic dividend that we've spoken much about in the context of Africa. So I think in the main, many of the pension funds were happy, amongst other things, for the separation of private equity from hedge funds, because in of itself, the two asset classes do not necessarily have the level of correlation that justified them being bundled into the same bucket. And this separation was helpful because it now helps in terms of the thinking around portfolio construction, with one considering the differences in terms of what levers they're trying to pull to what objectives, without having to balance the two. I think the second one is, it's obvious and glaring that in the South African context, we do need to be investing in infrastructure. I think the persistent load shedding that we experience, which I've heard some international news commentary now called rolling blackouts, are evident that we need to be investing in energy. But we also see on the roads now potholes that are covered in narrated discovery, which shows that the private sector is stepping in to fill a gap that exists, and directing investment into private equity for infrastructure will help to accelerate that. And I think a significant number of the pension funds are aware of that. And that is also showcased by that a lot of the pension funds with whom I have the privilege of interacting are ready, before we even have the full-on enactment of the amendment to Regulation 28, starting to think about their own strategy and how to manage their own investment policy statements towards achieving those specific goals in terms of investing into the infrastructure space at an accelerated rate. I think historically, while the levels of investment have been low in private equity, I think this will definitely change now. And it was probably positive for the industry that there was a muted change to the regulation, because it did cast a big spotlight on the industry and helped to propel the conversation on investment into unlisteds.
Okay, thank you so much. Okay, then I'll move to FSD Africa, Adebayo. From a development agency perspective, what do you think are some of the challenges that are hindering domestic institutional investors into private capital markets?
All right, thank you very much, Salaka, for that question. Most of the challenges we also see from a development agency perspective are some of the conversations we are having currently. But then just to provide some little perspective about how we see the role of domestic institutional investors play in our financial markets. We think they are very critical, not only in the financial market development, but also in promoting the behavior on the markets, and in contributing to the real and social economy, as Mr. Langard pointed out. So, and we know the pension fund industry happens to be the largest domestic institutional investors base we have in Africa. As we have alluded, their preference has always been the conservative approach to investing in traditional assets through the public markets, even as the study has revealed. But over the years, we've seen an increased appetite for the private markets, and this has grown over the past 2 decades. From over the last 5 years, the total assets under management on the private market has doubled from 5 trillion in 2017 to an estimated 10 trillion USD as of 2021. And this is partly because of the downside that we've seen on the public markets, occasioned by incidents of COVID-19. Though, I mean, there was a sharp recovery last year, but we didn't even see that in most public markets in Africa. So globally, investors are now looking for, a risk, a higher yield, and we think the private market provides this this avenue for them, and also much more importantly is the flexibility that the private market has presented in structuring transactions that better suits most of the MSMEs that drive economic growth in most African countries, right? As was mentioned, we've also seen the enthusiasm amongst African institutional investors, particularly in the pension funds, although we'll agree that there's still more to be done. One of the major constraints which has been re-echoed is the issue of the regulatory constraints in allowing pension funds to invest in this market. As it was pointed out in the study, most markets have between 0 to 5% allocation, though it's encouraging to see that some markets are now expanding these restrictions up to 15%. And we hope that as further markets emulate such regulatory changes, we'll see more assets being allocated through to the private market. Another key hindrance we see is the capacities constraints, and this may be closely linked to the issue of the regulatory constraints, because I think there may not be enough appetite, or there was not enough appetite for pension funds to develop capacity in this space due to the limited room to invest and expand. And one more thing I would like to point out is that the issue of the performance concerns of some of these private investments and lack of public information on them, which has been pointed out as well. I know there's also the fear of mismanagement or defaults because it becomes very difficult to assess some of these companies where there are no public information available. So those are some of the challenges that we have seen across the markets in Africa, and which we hope as the market develops in Africa, would find solutions to address them.
Okay, thank you. So a follow-up question would be, what role can development institutions play to address the challenges and support development of markets on the continent?
Okay, so I mean, from the study, we understand that some of the key things that pension funds, for instance, look for investments as a value proposition, the track record of the investment class, and probably the investment strategy. Yeah, so DFIs, as we know, in Africa are well versed in investing in private markets. As a matter of fact, I think the private market in Africa is really dominated by DFIs, and they've gathered a lot of experience in their space. One of the ways that I think DFIs can support the development of these markets is sharing their experiences with local investors, or finding vehicles in which those experiences can be leveraged in the areas of co-investing alongside local institutional investors. This would provide an avenue for capacity development in the specialized assets. But one key thing to note is the DFIs in developing these strategies should be ready to accommodate local currency investments, to crowd in local investors, to hedge the currency risk which we're seeing in most African countries. Another point that I see here is supporting actual capacity development and providing technical assistance in developing this market. One of the problems that has been highlighted is lack of information about this in private investments, and I think that brings issues around how the investment can be appraised or assessed. So I think developing frameworks that can sort of unify how domestic investors or pension funds can start to use to review private market transactions. We go a long way in providing comforts to domestic investors in assessing efficiently some of these opportunities. We've also seen in some markets the coming together of pension funds to create investment vehicles that specifically targets opportunities within the private markets, specifically in alternative assets and infrastructure. An example of that is the Kenya Pension Fund Investment Consortium, which is the coming together of 27 pension fund administrators in Kenya to see how they can pursue opportunities in infrastructure and alternative investments. This was made possible with the help of and support of DFIs. So locally, I think DFIs can start supporting such initiatives in specific markets to drive private investments. And the final thing I think is around the sustainable investing. It is interesting to note that part of the survey respondents agreed that in the next 5 years, sustainability would be mainstreamed in investments, particularly for local investors. So as we transit into a sustainable economy, it is important that local investors, local investor base takes this seriously. And with the experience that DFIs have in this space, they could find a way to support both regulators and players to see how they can incorporate some ESG strategies in assessing some of these investment opportunities. As it has also been pointed out, South Africa seems to be ahead in this initiative, and DFI can potentially support other countries in incorporating some of these ESG strategies into the investment guidelines.
Thank you, Adebayo. I'll just go back to Mozambique. Aldo, are you still there?
Yes, I'm here.
Yeah. Okay, so I just want to find out what is the status of development of the second and the third market on the stock exchange as a catalyzer for more investment opportunity in alternative financing solutions?
Currently, there's a drive from the stock exchange to actually develop it and have more and more entities registered in the second, third market. The idea when this was created is actually to have kind of an incubator period on where you would have entities registering, and with all the necessary requirements and guidelines, they will be able to transit to the first level of the first market, but they could start having trading on the second market itself. And that would allow that with the guidelines and the screening that the stock exchange will be doing, you will see a little bit more of trade, not only for the institutional investors, but as well for individuals and other companies. And then you will have alternate means of financing for these SMEs and SMMEs. Currently, it's actually one of those things that's been sitting in policy. A few companies are registering, but I believe that with enough information that and drive that the stock exchange is doing, will be able to grow. Just following ahead a little bit on what the bio was saying, definitely the role of the DFIs would be great appreciated in this point, because one of the things that you have mainly for Mozambique, it's in terms of regulation. The regulatory environment needs a little bit of overhaul and a kind of upgrading to allow more and more in this, and to facilitate the investment, not only in terms of the stock exchange, but as well to have VCs or PEs around the market. One of the other things is that in terms of taxation, all the investments done by the pension funds, all the type of investment basic tax on the corporate, the same base of a corporate tax, and that hinders a lot of the investment development in the market. But what we're seeing, it's a bit of people starting to understand and companies starting to understand what the stock exchange is, but the pension funds itself, they haven't yet branched out to invest more in the second or third tier. And where they actually invest, we see more investments on a buy and hold. It's what's happening more. So the pension funds go, they buy, and they sit onto those shares. Their trading is seldom done.
Apologies, we just had a load shedding in the office.
Apologies.
Yeah, so this is what I mentioned earlier on, that some of the challenges that are facing the country right now, the hindrances to the country. So I'm not sure how far you got to.
Yeah, I was saying that one of the things that's happening is, unfortunately, the pension funds are not investing much on the second or third tier. And when they do invest in shares in the stock exchange, it's much of a buy and hold. I think it's kind of a cultural thing as well, that they are kind of afraid of what's happening, of what, the stock market and all of those things can happen, volatility. But then mainly, even if they invest in the stock exchange, they tend to buy some of the bonds that are issued via the stock exchange, not entirely shares of companies. I haven't seen, if I'm not mistaken, any company that has raised from a pure startup, joined the stock exchange, and received investment from an institutional investor.
Thank you, Aldo. I'll go back to you, Mr. Langa. What more do you think could be done from a regulatory perspective to encourage South African retirement funds to invest in the rest of the region?
So I think from a South African pension fund perspective, the challenge that has existed with investing in the rest of the continent predominantly stems from some of the stories that we've heard and experienced. I mean, it's the experiences of MTN in Nigeria, NEMPEC, the inability to move capital within the continent. It's also been linked to issues of liquidity within the different markets, and how easy it is to buy in and to get out of certain positions that you hold within particular assets. So I think the majority of the regulatory work that would have to be done in the continent would be around predominantly the movement of cash. I think everyone is aware of the immense opportunities that exist within the various territories, countries, regions, and blocks that exist within the African continent. And many would like to take advantage of those. But I think the single greatest fear is around financial controls and the movement of cash between the different territories. So if we could definitely strengthen that, I think that would lead to greater levels of investments, because I think there are a considerable number of strategies that have been developed by fund managers in South Africa and in the rest of the continent that are investing into those spaces that I think pension funds would be interested in investing, but without the assurance that the capital invested will return, it becomes quite a difficult proposition to sell, to say, let's invest in the rest of the continent.
Okay, thank you, Mr. Langa. Shirley, I just want to know what are some of initiatives by SAVCA which are currently underway to increase pension fund allocation in private equity and private debt and venture capital?
Thanks, Shalati. So because our strategic objectives include promoting the asset class and obviously capacity building, we have some programs that actually look at building up capacity both at a pension fund trustee level as well as a principal officer. So what we do is we run an education program, and it's either a short course, which is half a day, where it looks to demystify private equity. It talks about the structures, you know, why do we do what we do? What does the tax transparency look like? Why is it a partnership? Those sorts of things, so that we are really just enabling the pension fund trustees and principal officers to ask their asset consultants the right questions. So also when you have fund managers that come and present, then it helps if you actually understand the lingo, you know what the objectives of the pension of the private equity fund manager is looking for. So really you can just enable that engagement. We also run a 2-day foundation program, which is actually being run later this month on the 26th and 27th of July. And that will also it's being run in Johannesburg. And that essentially looks at the whole life cycle of a private equity fund. So what it is to capital raise, why we do what we do, how do you look at the operational efficiencies in the underlying portfolio companies, and really what is this fund trying to do and how is it managed? And that really helps give people a bit of an understanding as to what it is to be a private equity fund manager, and really to help them and equip them to better invest in the asset class.
Okay, thanks, Shirley. I'll just also go back to Regulation 28. I just want to get your views. What did the 2021 proposed amendments to Regulation 28 entail? And what are you expecting that they will result in increased allocation to private equity, private debt, and venture capital?
So Shalati, I'll actually start by going back to Mr. Elias' comments earlier in terms of just taking people in terms of what was the journey from when Regulation 28, which is really that looks at the asset allocation and the limits in place and where private equity started. So although South Africa is the most mature in terms of regulation on the continent as it comes to private equity, when regulation for the financial sector was drafted, private equity wasn't really considered, you know, a couple of years ago, or quite a few years ago. So when the Regulation 28 came into effect initially, so not these last amendments, but sort of back in 2008, I think was the year, what the question was SAVCA had engagements with our policymakers at the time to be able to say, well, we think that private equity should have an allocation, and we think that pension funds should be able to allocate. And there was quite a lot of debate as to, okay, if we even put private equity as an allocation in other assets, what does that need to look like? And what they actually came up with, which I think is a useful starting point for sort of regulators to get their mind around investing, allowing pension funds to invest in private equity, was a set of rules that actually a pension fund can only invest into a private equity fund through a manager that is regulated. So they stipulated that it had to be regulated. And then they provided a couple of rules around what that needed to look like. There needed to be an annual audit. They need to apply the international private equity and venture capital valuation guidelines. There's certain controls that need to be in place. And really, it was almost like a 2 or 3 page document that just said, this is the type of fund that you are allowed to invest in. And then the allocation was quite low. But if you fast forward to the current amendments that have now gone through, that then allowed the regulator to get comfortable on a smaller allocation, that there was controls in place and that the market had evolved, that it can now actually increase that allocation without worrying that it could go awry or that the money could go to the wrong place. So it just provided those controls which help get people comfortable, both from a retirement fund perspective as well as a regulatory perspective, that there are controls around that. So I think the split out, as was referred to earlier, is quite key, and then the increase in allocation. what I think we're hoping will happen is that because it's now under a separate asset class, the question has to be asked is that if that asset class is sitting at zero, even if it's for a small fund or whatever the case may be, the question is if it's in your investment policy statement, why do you still have a zero allocation to it? What are the reasons for that? And then you can start unpacking the reasons. Is it because you don't feel like you have the right skill? Is it because your asset consultant isn't actually providing any opportunities for you to do that? And then essentially you can start having those questions to be able to say across the whole spectrum on a diversified portfolio, why am I missing a bucket? And what is my reason for missing this bucket? And am I really missing out for my own members? And that's what I think we hope.
Thanks a lot, Shedi, and hopefully we'll see some improvements to the allocation to the asset class. And then I'll pose my last question to Adebayo. As a specialist development agency working to reduce poverty by strengthening financial markets across Sub-Saharan Africa, what are the specific interventions that FSD Africa can support to assist in tackling some of the challenges that hinder pension fund investments in private equity and private debt?
Right. Thank you very much for that question. So one of our objectives in FSD Africa is to make finance work for Africa's future. And we seek to set up programs that addresses hindrances or barriers to free flow of capital to key sectors of the economy. And one of the challenges we see in most African countries is the lack of access to capital to SMEs, which are very important and vital to economic development. And this has been further exacerbated by the issue of COVID-19 and the public market not providing enough flexibility and innovation in structuring transactions that addresses the financing need of SMEs. And that is why we had in 2021 launched the African Private Equity and Private Debt Program, which is a Pan-African program that seeks to support the development of private market in Africa as a complement to the public market which we have. And the objective of this program is to see how we can mobilize domestic institutional investors or encourage domestic institutional investors in the program has been divided into various work streams. And one is about creating a facilitated environment that allows the participation of pension funds in this particular class of assets. So in this space, we work with regulators to put in place regulatory provisions or incentives that allow investment by relevant domestic institutions. Includes work with capital markets regulators, pension fund regulators, and also working with stakeholders in seeing how we can support their investment strategies in how they can invest more in the private market. Another work stream in this program is also supporting innovative transactions, demonstration transactions. So we also seek to work with market participants that have appetite for increasing their allocation into this market to see how we can support in setting up vehicles that allow the growth of this market. This may include things around seeing how we can sponsor a co-investment vehicle or actually developing a sponsored fund, which potentially our investment arm may be able to provide some catalytic capital to give comfort to domestic institutional investors. The key last aspect of this program is capacity development, which is one of the things we're trying to do here, to see how we can sponsor research into problems or hindrances or challenges that may hinder the growth in this particular space, and to encourage stakeholders to drive conversations around how we can potentially find lasting solutions into this particular asset class. In everything we do in FSD Africa, we always emphasize that we would want to leave the environment's more cardinal underlying factors in what you do. It's about to see how we can build a sustainable economy across Africa. So we also have an aspect that focuses on supporting pension funds to develop ESG strategy and to see how they can incorporate this into their investment thesis across their various asset classes. So this is one of the cardinal programs we've instituted in FSD Africa to specifically address some of the hindrances in this particular space. And as we have commissioned these studies, we are looking at working with key stakeholders in seeing how we can address some of the challenges that we've discussed and potentially see how we can demonstrate also transactions within the region that can serve like a proof of concept to investing in this particular asset class. Thank you.
Thank you so much, Adebayo. Brian, I'm not sure if you want to answer questions. I think we're done with the panel discussion. Moving on to the Q&A session. So Brian.
Yeah, thank you, Talati. There were some few questions in the Q&A chat box, but I think we've been able to address those live. But maybe just quickly opening up the floor for any questions that might be there. I don't know if we're able to receive them, but if there are any questions, feel free to just type away and we can be able to discuss them. But at the moment, I think all of them have been responded to.
Okay, thanks, Brian. So on that note, then, can I hand over to you and Shelley, and then we close, and then next steps, and then also the presentation will be available on FSD Africa, and the link will be sent on the chat box. I'll hand over to you, Brian and Shelley.
All right, thank you very much, Talati, and the entire team that assisted in setting up the session. Thank you as well to the attendees for making time to join, as well as for the for the questions that you shared. Hopefully, we've been able to adequately respond to them. Just to outline next steps, I think much of it my colleague Adebayo has addressed in the response to the last question. So we are happy to engage with stakeholders who may actually specifically feel that they may want to work with us in any of the three areas that Adebayo has highlighted. Regulatory kind of work, whether you feel we can or there's an opportunity to work together on transactions, or on capacity building kind of initiatives. We are happy to engage further on those and see how we can support the development of the market. I'll leave it there and hand it over to Shelley.
Thanks so much, Brian, and thank you very much to everybody for joining. I think the results of the research, I think, are very, very key in terms of working out where there's overlap and where SAVCA can support the various regions to be able to try and increase the allocation to this very important asset class, and work out that really there is a way to crowd in more private capital into really key developmental projects in the region, and to be able to foster that economic growth that everybody is chasing. So I think the same goes for us, that we are there to help and willing to assist. So please do engage with us if you've got some good ideas in terms of where there's alignment and where we can be of assistance. And that's all from me. Thank you very much.
Thank you so much, Shelley. Thank you to all our participants. So the link to the presentation will be shared by FSD Africa, and the final report will be accessible via FSD Africa's website. Thank you all.
Sorry, Ntalati, just before
Yes.
you end, I see there is a comment from William regarding his question. So we'll be able to answer that, William. We'll send it to you just because we've already closed. We'll ensure you get the response to the question. I hope that works. Okay, sorry, actually I see there are questions coming through. I don't know if we should extend for a few minutes to answer the questions.
Sure, go ahead, Brian. Sure.
Okay, fine. We'll actually start with William's question, and it was to Mr. Mvula. So he was, okay, maybe I would pose Dina's question first. The question is about the fees between the 2 and 20%, and how does one ensure growth is stable in light of these fees, and if there are any regulations on fees to pension funds. And I think there was a response to that, to the effect that if the investment is, if there is a strong case for the investment, taking into account all the risks or the risk return profile, I think pension funds should be able to get on board. But also there is the opportunity to consider a fund of fund kind of structures that maybe potentially have a lower kind of fee structure or a more favorable kind of fee structure. But then to Mr. Mvula, I don't know if you're able to quickly respond to William's question on this.
Yes, thank you so much. Maybe it wasn't seen I responded. I think that has to do with road tolling, if at all the pension funds in Zambia may be interested. So my response to that is that the pension funds are actually free to invest, especially that we've increased the threshold, as long as the tolling is quite lucrative and risks have been taken into account. And then the trustees are also happy with the investment which is being proposed. So it's very possible. Thank you.
Okay, thanks for that. Then maybe finally, there's one question from Polite. He asks, what are the key issues considered to ensure that private equity investment risk is reduced? Bio, I don't know, can I invite you to maybe comment on that? And any of the other panelists, if you feel like you can respond to it.
Okay, thanks, Brian. I can take the first stab at this. Yes, I mean, from a risk return perspective, yeah, private equity investments seems to be riskier, and over time they've been delivering above the yield returns as well. So I think the key thing here is to actually develop capacity in how to manage some of this investment internally, right? Of course, as we know in finance, the higher the risk, the higher the return. But then another thing that I would like to mention in terms of managing risk is in some markets, some pension funds have tried to mitigate this risk by sharing some of this risk amongst themselves. As a pension fund, you may not need to undertake some of these investments alone. And this gives room for also learnings across board, and also getting experienced fund managers has also been an issue that have really helped pension funds in mitigating some of this risk. I mean, those are just my thoughts around how the risk can be mitigated.
Yeah, to the other panelists, I don't know if you have some additional thoughts. Otherwise, we can probably leave it there.
Thank you, Brian. I don't think there's anything else coming up.
All right, thank you.
All right, thank you so much. Thank you all. Thanks for your attendance. And as mentioned, FSD will send the link for the slides, and the report will be accessible on the FSD Africa website. And thank you all. Have a good evening.
Thank you.
Thank you.